Good evening, good afternoon, and welcome to my investment club, where we discuss different topics related to the investment management, risk management, portfolio management, stock markets, investment strategies, and so on. During the last two streams, we have been discussing the topic of risk management using such measurements like value at risk or VaR and conditional value at risk or CVaR. And today I would like to show you how to measure those metrics for real life asset classes. What are the values for VaR and CVaR during different periods of stock market dynamics and how they relate to the so-called theoretical probability distribution, so how the theory can model the actual distributions of returns and the risk of these assets. So first of all, a small recap from our two streams. Value at risk is a risk metric that measures such amount of losses that the probability of getting a larger loss does not exceed a small pre-specified amount. And CVaR, or conditional value at risk, is the expected amount of losses that exceed the VaR. Expected shortfall is the same as CVaR. And in the case of continuous distributions, it's the same as the tail conditional expectation, or the expected value in the tail of the distribution. When we are working with the distribution of our returns, so we have asset returns, we have some expected return, we have zero, we have left tail, which is returns less than zero, so they are basically losses, and we set some threshold for our left tail. This threshold is VaR at some probability alpha, and the amount of probability inside this left tail equals to alpha, and threshold equals not exactly to VaR but to minus VaR divided by initial value of the portfolio. So it's called minus V, small v on this figure. And I prefer to work with the returns distributions, not with the losses distributions, and that's why I use negative signs before VaR and CVaR. And on this figure, CVaR is the expected value inside this left tail, and it's technically CVaR is like opposite value, and that's why I use minus C as CVaR divided by portfolio value. So there are the formulas VaR and CVaR, how they are defined mathematically, and small v is a relative VaR and small c is the relative CVaR. So it's what we defined during our previous streams. And now let's see how it works on real life assets. We use 11 asset classes modeled or proxied by exchange traded funds. This investment vehicle, which I talked about during our first streams, in my opinion it's the most convenient way for retail investors to get exposure to different asset classes. We discussed in a much detail why ETFs are such a convenient vehicle, and here all the asset classes are proxied with relevant ETFs. For example, large cap equity, it's a S&P 500 portfolio. It's tracked by ETF called SPY. The respective ticker is SPY. MDI tracks a mid-cap equity or index S&P 400. IJR tracks small cap equity index, S&P 600. They are all public equity indexes. And next three are bonds. IEF is ETF tracking a balanced portfolio of treasury bonds with average duration 7.6 years. So I suppose short-term, mid-term and long-term bonds all are there, so the average duration is kind of balanced. LQD is an ETF tracking the investment-grade corporate bonds index with the average duration 8.5 years. TIP is a ETF tracking the inflation-protected treasuries with the average duration of 7.6 years. So you see, for all three bond funds, the average duration is about the same. So they have about the same exposure to the interest rates curve and differ only with the level of their credit risk. And for TIP, it's also this inflation protected feature. Then we have VNQ, which tracks index for real estate investment trust, which is a proxy for real estate investments. Well, it's not the same as investing in a physical real estate, but it's the closest liquid asset we can use as a proxy for real estate. Then we have GLD, which is gold. Then we have QAI, which is an ETF tracking a hedge funds index. Well, very broad hedge fund index. Of course, different hedge funds, they pursue different strategies. Okay, so QAE tracks a broad hedge funds index for hedge funds that pursue different investment strategies. So it's kind of kind of eclectic, but still we don't have anything better in to check hedge funds industry. Then we have PSP, which is ETF tracking the private equity funds index. Again, a broad index, kind of eclectic. All funds are different, all funds are unique, and it's not very maybe not very useful, but still we have a broad index and we can see at least something about this asset class. And both QAI and PSP, they have kind of limited liquidity and limited time coverage, but well, it's better than nothing. And then we have MBB, which is an ETF tracking mortgage-backed securities, those products that were responsible for the financial crisis of 2008-2009, but still it's kind of interesting product, and let's see how its risk can be measured. We use 6 market periods between September 2000 and November 2017, and I subdivided them into kind of 6 sub-periods with distinct price dynamics. Well, maybe not the perfect classification, but still initially we had dot-com bubble, market crisis, declining prices, mostly for IT companies, but still it's considered a crisis until February 2003. Then a long period of market growth, where successful market. I remember that time very good time, and it seemed that the growth will continue indefinitely, but after that we had financial crisis, like subprime mortgage crisis. So that period I count until October 2007, and from November 2007 to February 2009 I consider as the financial crisis period and market decline, and after March 2009 until January 2015 is an rebound and growth period. Then a short period of flat market from February 2015 till May 2016, and from June 2016 till November 2017 is another growth period, and this research was performed in 2018. That's why this sample stops in November 2017. So you see the equity funds, they have full coverage. For other funds, we have partial coverage, especially for QAI, PSP, MBB. Bonds, real estate, gold, they have coverage except the first subperiod. So basically, how valued risk and CVaR looks like during different time periods and for different asset classes. On the upper figure you see valued risk at 5%, and first 4 lines actually they are credit instruments, 3 bonds funds and MBB, mortgage-backed securities. They have kind of lowest risk, lowest VaR, which is expected, of course, and they don't vary much across the different time periods. So their VaR is about 1% of the portfolio. Then we have all the rest asset classes. They have kind of similar market dynamics except for the period of financial crisis. So, except for the period of financial crisis, all the asset classes behave in kind of similar manner in terms of VaR. They have smaller VaR, which means smaller risk during growth periods, and they have larger VaR during crisis periods, especially during the financial crisis of 2008, which you can see. There are 3 exceptions here. The orange line, like dash dot line, it's gold. And risk of gold was lower than the risk of other asset classes except bonds during this financial crisis, which was expected. It was flight to safety. Then you see 2 asset classes that have the much higher risk, which is VNQ, it's real estate, and PSP, private equity. For real estate it's kind of expected because it was a subprime mortgages crisis. Real estate prices dropped significantly, so like losses amassed during that period. For private equity I don't know why that was high risk period for private equity. During other periods, private equity risk was about the same as public equity. Then, in terms of CVaR, we have a similar but slightly different picture. Again, 2 distinct groups of lines here. Credit products on top, so the lowest risk for credit products for bond funds and MBB, mortgage-backed securities, and all the rest asset classes, they have kind of similar dynamics in terms of CVaR. Again, you see gold, real estate and private equity behave differently during the financial crisis. Gold less risky, private equity and real estate much more risky during 2008. And the only exception from the previous figure, in case of CVaR, you see much higher risk for LQD, which is fund tracking corporate bonds, in comparison with the treasuries, which may be explained by the fact there were a series of corporate defaults during 2008, and that somehow affected the portfolio of corporate bonds. And that's why it did not affect much the threshold, risk threshold, which is VaR, but it did affect the expected value of losses, which increased comparing to the threshold. And by the way, we can see this ratio of CVaR to VaR. Mathematically, we don't have any strict relationship. We know that CVaR is definitely larger than VaR. It's obvious, but how much larger? We don't have any strict mathematical relationships, but empirically we can tell that the CVaR to VaR ratio is pretty stable in range of 1.2 to 1.6. So for different asset classes, for different market dynamics, it stays pretty much stable in that range, and roughly speaking close to 1.5, which I think would be a good rule of thumb to anticipate CVaR if you know the VaR. Two exceptions here. One is LQD, which I have already spoken about. I might guess that this outlier is due to corporate defaults during the financial crisis. That's why the CVaR soared comparing to like other periods, CVaR to VaR ratio. And the other outlier is private equity in years 2016-2017. I have no clue why that. I cannot explain this spike in CVaR to VaR ratio for private equity funds. Then the next block of our stream is how to use different probability distributions to model the returns and to evaluate risks using VaR and CVaR, because we can calculate theoretical VaR and CVaR using probability distributions and build the risk budgeting based on those numbers. But how good are those estimates? Let's see on different distributions. Here you see a lot of distributions that myself, that my co-author checked in 2018 on that sample of asset classes and time periods. Some distributions are familiar probably to you, like normal distribution, beta, Cauchy, I don't know, exponential, Laplace. Some distributions are kind of well, strange or uncommon, like VaR or the GAM or hyperbolic secant or Johnson's SU. But still, what else to note here in this table? If you see the asterisk, it means that the distribution is shifted. So for example, a log normal distribution, it starts from 0, but in our case, as we model the returns, the minimal return is -1, which is minus 100%, which is the lowest return. So we need to shift this distribution so that it starts at -1 instead of 0. So it's shifted. There are several shifted distributions, and in parentheses you see the amount of parameters for a particular distribution, because for some of them there are different versions for like 3 or 4 parameters, and if you see 4 in case of beta or Bird type 12 distribution, it means I used a distribution with 4 parameters. So what we see here, we see the best fit distribution. How the best fit is determined? We use two goodness of fit tests. First one is chi-squared, and the second one is Kolmogorov-Smirnov. We use combined p-value. For those, and here in like parentheses you see synthetic p-value, which is not a p-value for any particular goodness of fit test, but it's like a combined p-value from several tests. But the sense is, if you see a value closer to 1, it means it's a good p-value. If you see a number closer to 0, it means this distribution is bad. Even it's so it's a best fit. It's still quite a poor fit for this data sample. Well, what we see here, we see that for many equity funds, one of the best distribution is error or generalized normal distribution. For some we see Laplace distribution, for some we see beta, for some we see Degam distribution. For many bonds we see Burr type 12 distribution, for some we see Johnson's SU distribution, normal distribution, hyperbolic secant distribution, but quite a large number of Burr distribution, Johnson's SU distribution, Degam distribution, error distribution, Laplace distribution. What is the problem with that set of distributions? The problem is that we cannot calculate CVaR for some of them because we don't know the closed form formulas. For VaR it's not a problem because almost for any distribution we know the quantile function, which is used to calculate the value at risk. But for CVaR it's kind of tricky. We need to get a closed form formula. We can get it for the error distribution, for Cauchy distribution and so on. So I used like second set of distributions called feasible best fit. Feasible means if we don't know the CVaR for the error distribution for SPI during the first subperiod, we look at what's the next best distribution until we get the next best fit distribution with a known closed form formula for CVaR. In our case it's Burr distribution. Maybe sorry, it might be the second best or the third best, but it's the best feasible distribution that we can use for our model. And here you see the set of distribution is more limited. We see again a Burr distribution, Degam distribution, Laplace distribution, Johnson's SU distribution, and a bit of log logistic distribution, hyperbolic secant distribution. Probably that's all. That's all set of distribution. You may note that here you never see students' t distribution. Unfortunately, the software we used for statistical tests, it did not work with, like it had t distribution, but kind of a limited version, not generalized. And unfortunately, you can't use distribution with like mean 0 and unit standard deviation or unit scale parameter, unfortunately. And to use a generalized t distribution, it required manual calculation, which was like time consuming. So we did not put t distribution unfortunately here, but my guess is that t distribution would be definitely one of the best fit here in this table if it was available. But still we have quite limited number, and you see that Laplace distribution is kind of good for equities. Burr distribution we often see for fixed income. Johnson's SU we often see for some alternative classes. But what it means in terms of risk budgeting. So what if we use this theoretical distribution, we get the sample estimates of our parameters, and we calculate our estimated VaR or CVaR, and we base our risk budgeting on those numbers. Here you see over or underestimation of value at risk at 5%. So for example, you see the range here -1 to 1%. If we have a portfolio of 1 billion, for example, 1% is 10 millions. So you can see the magnitude. Magnitude on average is not very significant. It's under 0.2%, which is 2 millions on a billion portfolio. Only two outliers there. It's not critical, of course. In most cases, value at risk overestimates the risk budget, so actual risk is smaller than the estimation using the VaR. Average overestimation and average underestimation are about the same, and for like $1 billion portfolio it would be $700, which is not a significant value, but it's average. Of course, if you use extreme values, they would be more significant, and you see here the overestimation 0.33%, underestimation 0.49%, which is almost $5 million underestimation of risk on $1 billion portfolio. Well, not critical, but not very pleasant as well. If we use risk budgeting based on CVaR, the picture is worse. Obviously, you see most bars here are in the negative area. Risk is overestimated only in 35% cases. In most cases, almost 2/3 cases, we have the underestimation of risks. Average underestimation is much larger than average overestimation. So, on average, our distributions underestimate risk budget for CVaR, and CVaR is more interesting for us because it's the average amount of losses. It's not just a threshold. It's much more like tangible for investors. And the extreme values you see, they are larger in terms of underestimation. The overestimation is smaller, but the underestimation is kind of large, so you may underestimate the losses by as much as $8 million on a $1 billion portfolio, which is, well, not very good. Okay, so another point of our research is the joint probabilities of VaR and CVaR, overestimation and underestimation. Again, we are speaking of the feasible best fit distribution only, and for 5% VaR and CVaR. And you see, if we use this feasible best fit distribution, there are relatively comparable probabilities that we both underestimate VaR and CVaR or overestimate VaR and CVaR. There's very small, kind of small probability that we underestimate VaR but overestimate CVaR. But the largest probability is the opposite, that we overestimate VaR and underestimate CVaR at the same time. And it's the least desirable case, because VaR is the threshold, so we may overestimate threshold. We see that the actual threshold is lower, so we think that we are fine with the amount of risks taken by us on this portfolio, but the actual expected loss above this threshold would be underestimated. So if we use value at risk based budgeting, in most cases, the chances are high that you underestimate the average losses above this threshold that you put for your risk budget, and that's a kind of unpleasant finding of our research. We also looked at a least error distribution. So which distribution gives the lowest estimation error? In this case, of course, the errors are different for value at risk and for CVaR. For value at risk 1%, value at risk 5%, CVaR 1%, CVaR 5%. In all cases we have the different set of best distributions with the least error. So in this table you see the lowest errors for CVaR 5%. And you may know that in many cases the distributions that provide the least estimation error are not the same as the distribution that fit the data the best. So the best fit distributions are not the same as the least error distributions in many cases. Not always. So in some cases we see the Laplace distribution as the best fit and least error, or Johnson's SU. Probably those two we mostly find as both the best fit and the least error distribution, but otherwise the chances are that the best fit and the least error distributions are different. Here we see the distributions that we have not encountered in our best fit analysis, like log normal, generic extreme value, logistics. Well, that's probably it. Well, the amount of distributions is the set of distributions is limited because only feasible distributions are included here in this analysis. Okay, and what we can get if we use the least error distribution instead of the best fit distribution for the risk budgeting? You see here the VaR based budgeting. Please note that the magnitude on this chart is lower than the magnitude on the previous chart, because the previous one had -1% to 1%. This chart has minus 0.5% to 0.5%. So those bars they are visually lower, and the magnitude is 2 times lower as well. So while the risk is mostly overestimated as in the previous case, but the average overestimation and the average underestimation, they are more than 2 times lower. I think on average it's 4 times lower, 4 or 3 times lower, and you see extreme values again are 4 or 3 times lower. So the risk budgeting is much more accurate in this case. We don't need to waste money on risk budget if we actually don't need it, or we use enough money for risk budget if we indeed need them. The same is with CVaR. Again, you see the magnitude here is much lower. On overall risk is my bad, here is risk is underestimated mostly. No, it's right. So it's overestimated in 37% of cases. So in most cases it's underestimated again, as before, but the level of overestimation or underestimation is much lower than in case of best fit distributions, and the extreme values are 4 times lower as well. So you see, it's much more accurate risk budgeting, both on in terms of VaR and in terms of CVaR, if we were able to use the least error distribution. The problem is we don't know a priori which distribution would be the least error. If for the best fit distribution we can get a long sample and say that if this distribution fits to S&P 500 chart, that we use this distribution for our future samples, for future periods of large cap equity returns, and that makes sense if we believe that the distributions are pretty much stable. But for the least error, it's not the case. So we cannot a priori say that this distribution that had the least error in the past will also have the least error in the future. So that's the largest problem here. But if we were able to limit ourselves to a narrow set of kind of good distributions that provide the lowest errors on average, then we can improve the risk management a good deal. We can get more accurate risk budgeting and waste less money, or better assess risks of our portfolio. So what we can look at here, we can look at relative errors. Unlike the previous charts when we worked with absolute errors, the absolute errors were easy to convert to US dollars, right? Because you just multiply the error by the amount of the portfolio, you get the dollar value of your error. But for relative errors, it's like absolute error divided by its value. So, but relative errors, you cannot calculate dollar value easily, but you can compare different time periods and different asset classes. Because if you see one asset, it has error of 2 times, and the other have 2 times. They are comparable despite the fact the absolute amounts, absolute values may be different. So I used relative errors to calculate root mean squared error. So both negative and positive errors, they do not compensate each other. They are counted separately. So each absolute error, they're squared and they are summed, and average value taken, and then the square root taken of the sum of that amount, and you see here the average relative error. And some distributions that I indicated as kind of a good fit ones, they actually provide kind of high relative errors, unfortunately. For example, you can see Bird distribution and the GAM distribution. Despite the fact that they may be a good fit to the data, they fail to assess VaR and CVaR accurately. So we cannot use them, unfortunately. We see some distributions that were not the best fit, but they tend to be accurate to estimate VaR and CVaR, such as generalized extreme value, hyperbolic secant, and logistic. This error or generalized normal distribution, unfortunately, it's a good fit, low error, but don't have closed form CVaR, so we cannot use it for CVaR risk budgeting. and two other distributions that we have spoken about often during our today's stream, the Laplace distribution and the Johnson's SU distribution. It's interesting because they both were among the best good fit distributions. Like for many asset classes, they were the best fit ones, and they also tend to have low VaR and CVaR estimation error. For example, Johnson's SU distribution does a very good job, or even excellent job, at assessing VaR and CVaR at all levels that I have checked. For the Laplace distribution, we have a good estimation for CVaR 5%, a decent level of error for VaR, but not very good estimation for CVaR 1%. But if you speak about those two distributions, if you just need to do risk assessment and risk budgeting, I would definitely recommend the Johnson's SU distribution as your best choice, because it has lowest estimation error for both VaR and CVaR, and is often the best fit distribution, especially for alternative asset classes. The Laplace distribution is often a good fit for public equities, especially for fat tails cases. And when you see high errors here for the Laplace distribution, they are mostly due to the fact it overestimates risk. So you have here errors because of overestimation, not because of underestimation. So for most cases when there is a high tail risk, the Laplace distribution is a good choice. And another reason for using the Laplace distribution is very simple formulas. It's elliptic distribution, which means it can be used for the portfolio optimization. Last time I said that we can optimize a portfolio if the CVaR has a specific format that allows expressing it using the portfolio average return and portfolio standard deviation. For example, you cannot do that for Johnson's SU distribution, but you can do it for Laplace distribution, normal distribution, logistic distribution, and some other. And from that set of qualified distributions, the Laplace distribution is probably the best one. And if you need to optimize a portfolio based on CVaR, but instead of setting this CVaR probability and getting the lowest CVaR, you can have the opposite problem. You can fix the amount of loss, expected amount of loss, which is the CVaR value, and get the portfolio with the lowest probability of getting that CVaR. You might know that it's buffered probability of exceedance optimization. And last time I said that the optimal portfolio would be the same as the optimal portfolio that maximizes so-called synthetic Sharpe ratio. So for normal Sharpe ratio you have positive risk-free rate, which is 1%, 2%, 4%. But if you would like to optimize BPOE for CVaR level, let's say 5% of your portfolio, or let's say 0.5% of your portfolio, and you would like to get the portfolio that has the lowest probability that the CVaR would be 0.5% of your portfolio, you can get the solution by using the Sharpe ratio with the risk-free rate a level of minus 0.5%. And that and I showed that the problem, mathematical problem, is equivalent. BPOE optimization and Sharpe ratio optimization for the qualified distributions. And Laplace distribution is one of qualified distributions. So if you need to optimize the portfolio using the CVaR, then the Laplace distribution is probably your best choice, as you can use it, and it's not bad for fitting and for estimating. If you don't need portfolio optimization, then you can definitely use Johnson's SU distribution, which is the best for estimation and often the best for the best fit as well. So those two distributions, I think they made such a reasonable set of instruments for risk budgeting, risk management, risk optimization. So that's probably all I wanted to talk about today. I thank you for your attention. Stay tuned to this channel. We have just finished the risk management topic using VaR and CVaR, but I think there will be some other topics related to investment strategies, portfolio management, and some other topics in investment field. I don't think I will have the next stream soon, because I need to get some information, to get some ideas, and to prepare quality content for you. So if you'd like to get notified when the next stream will be scheduled, please feel free to subscribe to my YouTube channel or to check updates on my LinkedIn page. And thank you for your attention, and